Let me tell you something that most people in this space don't want to hear. And trust me, they're going to hate me for saying it. But I've never been in the business of making people comfortable. I've been in the business of making people rich, and there's a difference, a big one. So sit down, because what I'm about to say might challenge everything you think you know about digital currency, about wealth preservation, and about where your money actually stands right now in this economic moment. I've been in financial markets for over 40 years. I've seen bubbles form. I've watched them pop. I've seen investors, smart investors, educated investors, people who should have known better, lose everything because they confuse speculation with strategy. And right now, in 2024, we are in one of the most deceptive financial environments I have ever witnessed. Digital currency is devaluing. The numbers don't lie. The volatility is not a feature. It's a warning. And most retail investors are standing directly in the path of that warning with their eyes wide shut. So here's my question for you. And I genuinely want to know, so drop it in the comments right now. Do you believe digital currency is a legitimate store of value? Or do you think it's the biggest speculative trap of our generation? Tell me where you stand, because the answer to that question will determine everything about how you protect your wealth going forward. Now let me get into it. And I mean really get into it. First, let's establish something fundamental. Wealth preservation is not the same as wealth creation. These are two completely different disciplines. Most people think about making money. Very few people think seriously about keeping it. And that distinction, that gap in thinking, is exactly why the average person ends up with nothing while the wealthy keep compounding. It's not luck. It's not talent. It's a philosophy, a disciplined, ruthless philosophy about how money works and what it's actually for. Digital currency in its current state fails the most basic test of wealth preservation. And I say that not as someone who's against innovation. I've invested in fintech. I've sat on panels with some of the most brilliant blockchain engineers in the world. I respect the technology. What I don't respect is the mythology that's been built around it. The idea that Bitcoin or any other digital token is a safe haven for your wealth, that it's digital gold, is one of the most seductive and dangerous narratives in modern financial history. Here's why. Gold has been a store of value for 5,000 years. 5,000 years of human civilization, wars, empires rising and falling, fiat currencies being created and destroyed, and gold held. It held because it has intrinsic scarcity. It's physical. It can't be hacked. It can't be delisted. It can't be banned by a government press release overnight. Bitcoin has been around for 15 years. 15. And in that time, it's lost 80% of its value. Not once, not twice, but multiple times. You call that a store of value? I call that a casino with better marketing. Now, I know what some of you are thinking. You're thinking, but it always comes back, it always hits new highs. And you're right, it has. But here's the psychological trap in that argument. Survivorship bias. You remember the people who bought Bitcoin at 10,000 and sold at 60,000. You don't hear from the people who bought at 60,000 and sold at 16,000 because they needed to pay rent. You don't hear from the people who lost their life savings in Terra Luna. You don't hear from the people who had their wealth wiped out in the FTX collapse. Those stories don't go viral. Those stories don't get made into Netflix documentaries. But those stories are real, and they are far more common than the overnight millionaire narrative. Let me give you a number. At its peak in November 2021, the total cryptocurrency market cap was approximately $3 trillion. By the end of 2022, it had fallen to approximately $800 billion. That's $2.2 trillion in wealth gone, evaporated, in 12 months. Do you know what $2.2 trillion represents? It's larger than the GDP of most countries on Earth. That's not a correction, that's a catastrophe. And if your wealth was sitting inside that catastrophe, no amount of hodling philosophy was going to save you. So let's talk about what actually protects wealth. Because this is where I want to shift the conversation, not to pessimism, not to fear, but to strategy. Real, tested, time-validated strategy. The first principle is diversification, but not the kind of diversification your average financial advisor talks about. Most advisors will tell you to spread your money across stocks and bonds. That's 20th century thinking. In today's world, with currency devaluation happening globally, with central banks printing money at unprecedented rates, with geopolitical instability reshaping trade relationships, you need a more sophisticated model. You need what I call hard asset anchoring. Hard assets are physical, tangible stores of value that exist independent of any government, any central bank, any digital platform, or any regulatory environment. Real estate, precious metals, fine art, commodities. These are the categories that have held value through every financial crisis in modern history, through the Great Depression, through the stagflation of the 70s, through the dot-com crash, through 2008, through COVID. Hard assets don't go to zero. They don't get hacked. They don't require a password, and they don't disappear when a charismatic founder turns out to be a fraud. Now I allocate, and I've said this publicly many times, approximately 5% of my portfolio to cryptocurrency. 5%, not 50, not 25. 5. And that 5% is money I'm comfortable watching go to zero. Because that's the honest way to categorize it. It's a speculative bet. It's a lottery ticket with better odds and worse liquidity. And when you treat it that way, when you put it in its proper category, you stop making emotional decisions about it. You stop checking the price 17 times a day. You stop panicking when it drops 30% in a week, because you've already mentally accepted that this money is at risk. That psychological clarity is worth more than any trading strategy you could ever learn. The second principle of wealth protection is what I call currency diversification. And this is critically important in a world where digital currencies are devaluing and where even traditional fiat currencies are under pressure. If all of your wealth is denominated in one currency, even the US dollar, you're taking a concentrated risk that most people don't recognize because it's invisible. The dollar has lost 97% of its purchasing power since the creation of the Federal Reserve in 1913. 97%. That's not a talking point. That's Federal Reserve data. As public record, smart wealth protection means holding assets across multiple currencies, multiple jurisdictions, multiple asset classes. It means thinking like a central bank thinks, because that's exactly what you're doing when you manage significant wealth. You're your own sovereign wealth fund. And sovereign wealth funds don't put everything in one basket. They don't gamble their reserves on volatile digital tokens. They build portfolios designed to endure, designed to survive any single catastrophic event in any single market. The Swiss franc, the Singapore dollar, physical gold held in allocated vaults across different jurisdictions, income-producing real estate in stable political environments, blue-chip equities in companies with genuine pricing power and strong balance sheets. These are the instruments of serious wealth preservation. These are the tools that the ultra-wealthy actually use, not the tools they talk about on social media. Because the ultra-wealthy understand something that most retail investors don't. The first job of money is to survive. Growth comes second. If your money doesn't survive, there's nothing to grow. Let me contrast two investors for you. Both start with the same amount of capital. Let's say $500,000. Investor A puts $250,000 into cryptocurrency, Bitcoin, Ethereum, some altcoins because they heard about them on a podcast, and puts the rest in a diversified equity portfolio. Investor B puts $25,000 into cryptocurrency, puts $100,000 into physical gold and silver, puts $200,000 into income-producing real estate, and keeps $175,000 in a diversified equity portfolio with an emphasis on dividend-paying companies with pricing power. Now watch what happens across a 5-year period that includes a crypto bear market. Investor A watches half their portfolio collapse by 70% or more. They're stressed. They're making emotional decisions. They sell at the bottom. They miss the recovery. They end up with significantly less than they started with and a great deal of psychological damage. Investor B watches their crypto position decline sharply, but it's a small fraction of their overall wealth. Their real estate is generating rental income regardless of market conditions. Their gold is holding value or appreciating in an environment of uncertainty. Their equities are paying dividends that compound quietly in the background. At the end of 5 years, Investor B is wealthier in real terms, even if Investor A's crypto is recovered. Because Investor B never had to sell under pressure. They never had to make fear-based decisions. They had the luxury of patience because they had the architecture of stability. That architecture, that structural approach to wealth, is what separates people who build generational wealth from people who spend their lives chasing the next hot thing. And now I want to address the devaluation issue directly, because it's at the core of what we're talking about. Digital currencies devalue for several reasons, and most retail investors don't understand all of them. The first reason is supply dynamics. Unlike gold, which requires enormous physical effort to extract and has a naturally limited supply, most cryptocurrencies can be forked, copied, or otherwise replicated. Yes, Bitcoin has a 21 million coin cap, But there is no cap on the number of Bitcoin alternatives, Bitcoin clones, or entirely new blockchain-based tokens that can be created and marketed to retail investors. Every new token that enters the market dilutes the narrative of scarcity. Every new next Bitcoin takes capital away from the existing ecosystem and redistributes it across an ever-expanding universe of speculative assets. The second reason is regulatory risk, and this is the one that keeps sophisticated investors up at night. Governments around the world, from the United States to China to India to the European Union, are actively working to regulate, restrict, or in some cases completely prohibit certain forms of cryptocurrency activity. And here's the brutal truth: governments always win. They always win. They have the legal authority, the enforcement power, and the political motivation to control monetary systems. The idea that cryptocurrency is beyond government control is a fantasy. It's a fantasy that has already been disproven multiple times in multiple jurisdictions. When China banned crypto trading in 2021, the market crashed. Not because China is particularly powerful in the global economy, though it is, but because the demonstration of regulatory power sent a signal to every other government in the world, and those governments heard it. The third reason for digital currency devaluation is what I call the utility gap. For a currency to hold value, it needs to be widely accepted as a medium of exchange, reasonably stable in value, and trusted by both parties in any transaction. Cryptocurrency currently fails on all three counts for the vast majority of real-world transactions. You cannot pay your mortgage in Bitcoin. You cannot buy groceries with Ethereum in most places on Earth. You cannot reliably plan a business around a currency that can drop 30% in a week. Until cryptocurrency solves the utility problem, it remains a speculative instrument rather than a functional currency. And speculative instruments, by definition, cannot be the foundation of wealth preservation. Now here's where I'll push back on my own argument slightly, because intellectual honesty demands it. There are legitimate use cases for blockchain technology that I believe in deeply. Cross-border payment efficiency, smart contract applications in specific industries, supply chain verification, financial inclusion for the unbanked. These are real problems that blockchain is genuinely capable of solving. And there are companies and projects working on exactly these applications that I find compelling from an investment perspective. But there's a critical distinction, and this distinction is everything, between investing in the technology and speculating on the token. These are not the same thing. You can believe in the internet without believing that every .com stock in 1999 was worth its valuation. And you can believe in blockchain technology without believing that every cryptocurrency token is a legitimate store of value. The .com analogy is one I keep coming back to because I think it's the most instructive parallel in modern financial history. In the late 90s, the internet was real. The transformation it would bring to commerce, communication, and human productivity was real, but the valuations placed on .com companies were completely disconnected from business fundamentals. Companies with no revenue, no profit model, and no clear path to sustainability were valued at billions of dollars based purely on narrative. The narrative of disruption, of technological revolution, of getting rich if you just got in early enough. Sound familiar? Thousands of those companies went to zero, completely to zero. And the investors who survived, who actually built wealth through that period, were the ones who were invested in the genuine underlying technology, not in the speculative hype layered on top of it. The ones who bought Amazon and held. The ones who bought Microsoft and held, not the ones who bought Pets.com. The cryptocurrency space is undergoing the same kind of Darwinian selection process right now. Most tokens that exist today will not exist in 10 years. The vast majority will go to zero. And the ones that survive, the ones that build genuine utility and institutional adoption, may well become significant components of the financial system. But identifying which ones those are from the current landscape of 20,000 plus cryptocurrencies requires a level of technical expertise and access to information that the average retail investor simply does not have. You are, almost by definition, the least informed participant in that market. The insiders, the venture capitalists, the early miners, the core developers, they already hold the majority of supply and most tokens. When they want to exit, you are their exit liquidity. That's not cynicism, that's mathematics, so let me give you the practical framework, the actual blueprint. Because I don't believe in just identifying problems without offering solutions. That's not how I operate. First, and this is non-negotiable, define your risk capital. Before you put a single dollar into any speculative asset, determine the absolute maximum amount you can afford to lose without it affecting your lifestyle, your security, or your sleep. That's your risk capital. Nothing more. Put your speculation money in a speculation bucket and leave it there. Do not add to it when prices go up because you feel like you're missing out. Do not add to it when prices go down because you want to average in. Define it, set it, leave it. Second, build your foundation first. Before you speculate on anything, make sure your foundational wealth architecture is in place. This means emergency reserves of 6 to 12 months of living expenses in liquid, stable assets. It means adequate insurance, life, disability, liability. It means no high-interest debt. It means you own your housing situation with a clear strategy, whether that's a fixed mortgage at a favorable rate or a deliberate decision to rent and invest the difference. The foundation has to be solid before you build anything on top of it. Most people skip the foundation because it's boring. The wealthy don't skip the foundation because they understand that boring wins. Third, allocate to hard assets systematically. I recommend a minimum of 20 to 30% of a wealth preservation portfolio in hard assets, precious metals, physical, not paper, not ETF, not crypto. Real estate, income producing where possible. If direct real estate ownership isn't accessible, high-quality REITs in stable markets are a legitimate alternative. Commodities do disciplined ETF exposure. These positions don't need to be actively managed. They don't need you to check them every day. They're the anchors of your financial ship. They keep you stable when the speculative parts of your portfolio are getting tossed around by the storm. Fourth A, income is king. This is the mindset shift that separates the wealthy from the high income but broke. It's not about how much money you make. It's about how much income your assets produce. A passive income stream from dividends, from rental income, from royalties, from interest on high-quality fixed income is fundamentally different from capital gains because it doesn't require you to sell anything to benefit from it. You collect the income while the asset continues to exist and ideally continues to appreciate. The goal of wealth preservation is to build an ecosystem of income-generating assets that funds your lifestyle without ever needing to draw down on the principal. When you reach that point, you've won the financial game. Everything else is just entertainment. Fifth, understand the tax dimension of every decision. This is where most retail investors give back enormous amounts of wealth. They focus on returns and completely ignore the tax consequences of their strategy. Cryptocurrency, in particular, creates extremely complex tax situations. Short-term capital gains, wash sale rule ambiguities, the nightmare of tracking cost basis across hundreds of transactions on multiple exchanges. The wealthy pay for sophisticated tax advice because the return on that investment is measurable and significant. If you're not working with a qualified tax professional who understands your full financial picture, you're leaving money on the table. Guaranteed. Now let me talk about something that doesn't get discussed enough in conversations about digital currency and wealth, the psychological dimension. Because finance is not a pure logic game. It never has been. Human beings are emotional creatures making financial decisions in an environment designed to exploit those emotions. Social media feeds filled with people showing off their crypto gains. Influencers with 17 Lamborghinis and a course to sell you. FOMO, fear of missing out, is a genuine neurological response, not a character flaw. It's an evolutionary mechanism that once kept our ancestors from being excluded from the tribe, now weaponized by algorithm-driven platforms to keep you engaged and keep you spending. The antidote to emotional decision-making in finance is what I call pre-commitment strategy. Before you invest in anything, write down your thesis, why you're investing, what you expect to happen, over what time frame, and under what circumstances you would exit. Then put that document somewhere you have to physically access when you're tempted to make an emotional trade. Make yourself read it before you make any significant financial decision. This forces a gap between impulse and action. And in that gap, more often than not, rational thinking reasserts itself. This sounds simple. It is simple, but it's also extraordinarily effective, and almost nobody does it. The wealthy also understand the concept of asymmetric risk. They're not trying to maximize returns on every position. They're trying to build positions where the downside is defined and limited, and the upside is theoretically unlimited or significantly larger than the downside. This is why smart money in the cryptocurrency space, the institutional money, the family office money, participates with small defined positions rather than concentrated bets. They get the potential upside, they cap the potential downside, and they structure the rest of their portfolio to ensure that even if every crypto position went to zero, their overall financial picture remains intact. The retail investor, by contrast, frequently does the opposite. They concentrate. They put meaningful percentages of their net worth into highly speculative positions because the narrative is compelling and the potential gains are seductive. And then, when the market turns, as it always does, as it always will, they're not in a position to absorb the loss without it fundamentally damaging their financial future. I want to address the generational element here because I think it's important. Younger investors, and I'm talking specifically to anyone under 40 who's watching this, have grown up in a world where the internet, social media, and digital technology have been net positives in their lives. It's natural that you'd be more inclined to trust digital currency as a concept. It fits the narrative of your generation: decentralized, democratized, disruptive. And I respect that instinct. But I want you to understand that the digital revolution and the financial soundness of digital currencies are two separate things that don't need to be true simultaneously. You can embrace the digital economy. You can work in tech, build companies that leverage blockchain, invest in infrastructure plays across the digital ecosystem, and still maintain a wealth preservation portfolio that's anchored in hard assets and income-generating investments. These are not contradictory positions. In fact, the most sophisticated young investors I know hold both simultaneously. They speculate intelligently with a defined portion of their capital, and they preserve intelligently with the rest. They're not all-in believers, and they're not dismissive skeptics. They're pragmatic strategists, and that pragmatism is worth more than any ideological position. Let me talk about inflation, because in any conversation about wealth preservation, inflation is the silent enemy that most people underestimate. Inflation doesn't make the news the way a stock market crash does. It doesn't happen in dramatic moments. It happens slowly, insidiously, like water eroding rock. You don't feel it day to day, but over a decade, over 2 decades, it can destroy a significant portion of your real purchasing power if you're not positioned correctly. The conventional wisdom is that equities are an inflation hedge because companies can raise prices and maintain real returns over time. This is broadly true for quality companies with genuine pricing power, but it's not universally true. And it's particularly not true for growth companies with high valuations and no current earnings, which is a significant portion of the modern equity market. These companies are exceptionally vulnerable to rising interest rate environments because rising rates increase the discount rate applied to future cash flows, which mechanically reduces present value. This is not theory. This is what we watched happen in 2022, when the Federal Reserve began its rate hiking cycle and the Nasdaq lost a third of its value, while highly speculative growth stocks lost 50, 60, 70, 80%. Real assets, property, commodities, infrastructure have historically been much more effective inflation hedges than either equities or digital currencies, for the simple reason that they're priced in the physical world where inflation actually lives. When construction costs go up, when land values go up, when food prices go up, the assets tied to those physical realities reflect those increases in their valuations. That's mechanical. That's reliable. That's the kind of protection that should form the backbone of any serious wealth preservation strategy. Gold deserves particular attention in this conversation. I know gold is old-fashioned. I know it's not exciting. I know nobody at a dinner party is going to look impressed when you tell them you hold a significant allocation in physical precious metals. But I also know that gold has outperformed the S&P 500 over multiple extended time periods, that it has a near-zero correlation to equity markets in periods of systemic stress, and that central banks around the world, including countries like China, Russia, India, and Turkey, have been dramatically increasing their gold reserves precisely because they're hedging against dollar devaluation and geopolitical uncertainty. When the people who manage national treasuries are buying something, I pay attention. And right now, they're buying gold. Not Bitcoin, gold. There's also the question of leverage, the use of borrowed money to amplify investment positions. And I cannot overstate this clearly enough, using leverage in speculative markets is one of the most reliable ways to destroy wealth in human history. The cryptocurrency space has normalized leverage through derivatives platforms, margin accounts, and exotic financial products that allow retail investors to take positions many times their actual capital. This creates the illusion of wealth during bull markets and absolute catastrophe during corrections. I've seen the data on leveraged cryptocurrency positions during the 2022 bear market. The liquidations were staggering. People lost not just their investment, but money they didn't even have, leaving them in debt with nothing to show for it. If you're using leverage to speculate on digital currency, you're not investing. You're gambling with a time bomb. Let me come back to where I started, because I want to tie this together. Wealth is not about being right about every asset class. It's not about perfectly timing markets. It's not about finding the next Bitcoin or the next Amazon or the next whatever. Wealth is about building a system, a deliberate, disciplined, boring system that preserves and compounds your capital across decades and across economic cycles. It's about understanding that every financial decision involves a trade-off between risk and return, and making those trade-offs consciously with clear eyes and full information, rather than emotionally in response to social pressure, media narrative, or the fear of being left out. The people who secure their wealth against devaluation, against any kind of devaluation, digital or otherwise, are the people who refuse to be swept up in the narrative of the moment. They're the people who ask hard questions. They're the people who demand evidence rather than enthusiasm. They're the people who understand that in financial markets, the crowd is almost always wrong at the extremes, both at the top, when everyone is euphoric, and at the bottom, when everyone is terrified. Right now, we're at a moment where the narrative around digital currency has gone through an extraordinary cycle, from euphoria to devastation to partial recovery to cautious optimism. And within that cycle, retail investors have lost hundreds of billions of dollars of real hard-earned wealth. Not because cryptocurrency is inherently evil, but because the narrative outran the reality, because speculation was dressed up as investment, because the products were marketed to the masses before they were mature enough, stable enough, or regulated enough to serve as legitimate wealth preservation vehicles. That may change. The technology is real. The innovation is genuine. Institutional adoption is happening in specific regulated forms. Bitcoin ETFs, for instance, represent a meaningful legitimization of the asset class in a format that provides regulated access and proper custodianship. I watch these developments carefully. I participate where the risk-reward is justified. But I do not bet my foundational wealth on them, and neither should you. Secure your foundation first. Hard assets, income streams, tax efficiency, risk management. These are the pillars. Everything else, including any allocation you choose to make to digital currency, sits on top of those pillars, not underneath them. When you build it that way, you have the stability to take calculated risks without those risks threatening your future. You have the patience to let compounding work across long time horizons without being forced to sell at the wrong moment. You have the freedom that comes from not being financially vulnerable to any single event, any single market, or any single asset class. That freedom is what real wealth actually means. Not the Lamborghini, not the yacht, not the private jet. The freedom to make decisions based on what you want, not what you need. The freedom to be patient. The freedom to be selective. The freedom to say no. Start building that freedom today, not by chasing the next hot token. By getting ruthlessly disciplined about what you own, why you own it, and how it fits into a coherent long-term strategy for protecting and growing your wealth. Because in the end, that's the only financial strategy that has ever actually worked for anyone, in any era, to any economic environment. And that's not a theory. That's 40 years of watching what actually works in the real world. If this gave you something to think about, hit the like button, subscribe if you haven't already, and most importantly, drop your answer in the comments right now. Do you think digital currency can ever become a true store of value, or is it permanently a speculative instrument? I read the comments. I want to hear where you stand. See you in the next one.